What's up, chat? Let me know how the volume is. We'll get some music playing here. We get the FOMC meeting going live in about 50 minutes or so. We'll get a timer up. And, yeah. NASDAQ, you can kind of see, is slightly down since we last looked at it earlier this morning. But not in a terrible spot here. You know, not really much movement. Oil is back up to 73. It had a dip back down here after testing 74s. NVIDIA currently at 145. So NVIDIA's honestly had a really nice run all morning. Let's get some music going here. Oh, dude, yeah, I'm still not feeling good, bro. At least most of the market's closed tomorrow, right? Let me make sure. I know you guys could probably hear the music now, but there we go. That's better. Let's do a poll here. Again, here's the NASDAQ. I'm going to put the SPY up here because I think the SPY is just overall more relevant. Maybe zoom in a little bit here so we can get the full picture of what's going on. Yeah, the dot plot is a big story of the day for sure. All right, so the army is at the peak of its preparations for the U.S. to enter the war in Iran, according to Al-Hadath, citing broadcasting sources. So today, here, let me close this door. So today, Fed is forecast to keep rates at 4.25% to 4.5% for the fourth consecutive meeting. Now, this comes under the heels of the president pushing for lower interest rates. The dot plot will show future rate expectations, and they're doing this today. They're updating the dot plot today, particularly whether the Fed now sees forecast one cut instead of two, which they gave in March for 2025 this year. How many cuts we're going to do this year? You know, you can watch for the summary of economic projections. It's expected to highlight slower growth, higher inflation, and a more cautious outlook. Powell's Q&A is going to begin at 2:30, and we're going to stream it all fully live right here as we speak. You know, you want to listen to a couple different things. The first one is like tariff and geopolitical tension. You know, so buzzwords regarding tariffs, geopolitical stuff going on right now with the Middle Eastern conflict. Inflation and labor data updates. You know, we want to look at recent cooler CPI updates, and jobless claims data may support a dovish shift, but the Fed's still cautious. Most people expect the market to pause rates today, or the FOMC to pause rates today. Future cuts likely later in September is when they're looking at cutting. Fundstrat's Tom Slee believes soft inflation data could spark a rally after this meeting. And so rates unchanged, watch for fewer signs of cuts or communication nuance in the dot plot, likely cautious data-driven. Yeah, let me turn this music down a little bit. An acknowledgement of tariff inflation. Let's see if Powell says anything good here. Yeah, we'll get a timer up. We'll do a poll live here as well. We're going to do a poll. How many cuts will we get this year? 1, 2, none. Something else. Comment. That's the question for today's FOMC meeting. How many rate cuts did we get this year? Hey, what's up, Sam? I mean, I'm not feeling 100%, but yeah. Yeah, the markets are going to be closed. The futures market is going to be open. The actual S&P and NASDAQ are going to be closed, but the futures market is going to be open for a half day tomorrow. It closes at 1 p.m. Eastern time. Ugh. Yeah. Yeah, so we want to listen to for remarks regarding how many rate cuts we get this year. Dot plot updates. Yeah, so the updated dot plot is done quarterly. Do me a favor, hit the like button, hit the subscribe button, hit the notification bell. We're going to get a timer up in just a second. All right, chat. We are now testing. Look at 22.25, and then we got 22,000 underneath us for the NASDAQ. If we're looking at the SPY, you want to watch probably $600 as a big level here. $600 is an important level to watch. New York Fed RRP or OP demand at 205, previous 169. All right, guys, so here we go. So we're doing a post. Again, in the dot plot is probably the biggest story today. I mean, anytime like an outcome is this probable in terms of the FOMC, it pivots to if it's the quarterly update in the dot plot and summary of economic projections. That's where most of the attention pivots to, as well as what Powell's obvious tone is. And so that's an important update here, and we'll see what we get. All right, so I'm seeing incoming reports of U.S. fighter jets flying near the Middle Eastern borders, according to some people in X. And again, we're going to cover all this. You won't have to go anywhere. Today is the June 18th meeting. Yeah, so I'm looking for today. We got the FOMC meeting. I'm looking on the site. So look at this breakdown under that 25 level in the NASDAQ here. Looking at our poll numbers, 32%. We're pretty split between 1 and 2 rate cuts this year projected by the chat. 32% of people, roughly a third, think we're going to get 1 cut this year. 32% think we're going to get 2 cuts. 32% think no cuts. 4% think something else. So, interesting here. So in March, they gave us 2 rate cut projection. But today we get the updated dot plot information. And so that expectation of how many cuts we're going to get this year might change. So again, they gave us 2 rate cut projection in March. Today they're going to update that, and that's where a lot of people's eyes are going here today. Yeah, Bitcoin, when we're looking at this, Bitcoin at 104.30s, 104.30s. Still got 40 minutes until this report, but yeah. All right, so look at this NASDAQ dropping here. It could be something about this. So this news report just dropped. And look, it hit 22,000. So Director of National Intelligence Gabbard canceled a scheduled briefing with the Senate Intelligence Committee on Wednesday today amid ongoing tensions in the Middle East, multiple sources told Axios. And look at this breakdown we're getting in markets here. And again, if you want to look at the summary of economic projections chart, which again is going to be updated today, basically they think this year, they think by 2026 we're going to be at 3.4%. By 2027 we're going to be at 3.1% for interest rates. Or no, for GDP is probably what this means. I'm sorry, not... Oh, no, this is for the federal funds rate median. Okay, yeah. Yeah, I'm running a little slower today, guys. I'm doing my best, but... Yeah, looking at March, here's the last dot plot. And so again, here's the Fed funds rate. They think it's going to be by 3.1%. The NASDAQ still dropping by 2027. That is 3.1% by 2027. The NASDAQ still falling down. We're now underneath 22,000. And looking at the last update here. It said most likely outcomes for real growth, the unemployment rate, and inflation. All right, look at the NASDAQ still fall. I think 26 we're going to have a little bit better GDP. 27 we're going to have a little bit better GDP. The December projection, or no, 1.7% change in GDP. 1.8 to 2.2%. I think unemployment rate's going to be 4.4%, which is roughly where it's at now. It's going to decrease a little by 2027. Longer run, they think 4.2%. And this is the last time they did it. PCE, inflation. You see changes in GDP, unemployment. Look at the NASDAQ fall. I guess it's on this update that the Director of National Intelligence, Gabbard, canceled a scheduled briefing. That's got to be what it is. What happens today if they decide to cut 25 or 50? I mean, it wouldn't be for no reason. If they do that, it could. We don't really know how the market would respond. Market can respond in a lot of different ways. Specifically, a shocking pivot to a cut immediately might signal panic and freak people out. And so it could signal panic and scare everybody. Or it could, market kind of wants rate cuts, right? But I think if this isn't the way to do it. And so I think if we did cut today, even though it's 99.9% likely that we will not, it's going to freak people out. Most likely. Most likely. Gabbard. Bro, if y'all think I have the National Intelligence Director memorized how to say his name, you're wrong. I look at economics, not really defense, to be honest. I'll cover defense stuff, but you guys know me. I'm not really getting super deeply involved in that. It's too polarized. All right, so we're now under 22,000. The SPY is now at 599s. Bitcoin sitting under 104 105s. Oh, her name. Yeah, see, I have, like I said, I don't watch security and defense stuff. I really don't. Oh yeah, let's get a countdown here. We're gonna get a countdown to the rate decision, and then we'll pivot to a countdown to the speech. Okay, so here is a countdown to the rate decision. All right, we're also seeing some updates here. I'm seeing White House Chief of Staff Susie Wiles told Senate Republicans that they should pass the reconciliation bill next week. She says the administration wants it to be on the president's desk by the 4th of July, according to Punchbowl. Okay, so what can happen in this meeting for us to be green? Well, they could increase the odds of rate cuts this year. In the summary of economic projections, and so they could increase the odds of a cut. And so the market generally wants rate cuts, right? And so if we end up cutting rates earlier than expected, I think the market might like that. I don't think we're going to cut today. I think if we do, that actually might, even though it's counterintuitive relative to what I just said, I think the market might actually go down. Fitch on the U.S. says they expect fiscal deficits to remain high in the coming years because they do not expect there to be significant additional fiscal policy changes. And so just remember, like the dot plot, when we look at it, is a visual tool used by the Fed to show where each FOMC member thinks interest rates should be in the future. Each dot represents one member's forecast. The current year, next 2 years, longer run, aka neutral. It's published 4 times a year: March, June, September, and December. And the next one is today. It's anonymous. We don't know which member said what or wanted what. It's a section within the summary of economic projections, which also includes GDP forecasts, unemployment projections, core and headline PCE, and longer run economic expectations. And the NASDAQ is dropping down here for sure. Always there, my man. Thanks for the consistency. Hey, thank you, brother. Oh. Yeah, I'm sniffling right now because I have the flu. I tested positive for the flu this morning. And I'm still here doing this live stream, so you're welcome. Shout out to the drug references, though, I guess. But yeah, we're at 21,980s. Nasdaq's breaking down on uncertainty in the Middle East. Markets close early. Stock markets close. Futures market remains open until 1 o'clock Eastern time tomorrow. So stock market closed. Futures market open until 1 o'clock Eastern time tomorrow. Yeah, I feel horrible. Like, genuinely horrible. Ugh. Yeah. You're welcome, guys. That's right. Yeah, it's all good, brother. I appreciate it. Yeah, I love you guys too. You know, y'all are good people. I think most of y'all, some of y'all. You know. All right. It's weird though. Like, I tested positive for the flu. I have no fever, but my throat hurts incredibly bad, and no fever. My nose is completely like, I can't even breathe out of my nose, which probably explains the sore throat. But I also just have cold chills, like terrible cold chills. But when I take my temperature, you know when the thermometer says, like, it's got a little arrow for where your temperature is supposed to be? Every time I take my temperature, my temperature is literally exactly on that arrow. And so it's like the perfect temperature. It's like 98.6 or whatever number they use. But then I tested positive for the flu, and it feels like it because I feel horrible. But very strange, very strange. I'm starting to think my thermometer's broken or something. Yeah, negative for that. I was negative for that. All right, so look at the NASDAQ breakdown. So I'm looking at I'm seeing IDF spokesperson says they will continue to strike reactors. So we're seeing that. One of the armies overseas says that Iran has a plan to launch from their borders. And so we're getting a lot of Middle Eastern conflict news reporting right now. This is what's pushing the market down. Middle Eastern conflict stuff. I'm sure oil in this, like, simultaneously is pushing up some, right? Yeah. I mean, honestly, oil's not really reacting here. You know, it could be Fitch from the U.S. They expect fiscal deficits to remain high in the coming years because they do not expect there to be significant additional fiscal policy changes. We also have some stuff that the Director of National Intelligence, Gabbard, which apparently is a female, canceled a scheduled briefing with Senate Intelligence Committee on Wednesday amid ongoing Middle Eastern tensions. And I think all of it's just not good. SPY is down. NASDAQ is down. Q is down. Apple's down. Amazon's down. Microsoft is down. Tesla's down. And before we get the people coming in here being like, I told you the market was going to crash, bro. This is nothing near a crash. The market's literally down. Like, the NASDAQ is down like $100. Hey. My wife bought more tests. It's got to be, though. Like, the likelihood that I would have a positive test and feel terrible
or it's just an old test.
Is low. Huh?
Or it's just an old test.
An old test that randomly flags positive? I don't think so.
It happens.
I'm sure it happens, but the probability of it's pretty freaking small, I think. But that's all right. All right, guys. So NASDAQ still breaking down. We got 30 minutes until the FOMC decision goes live.
See, look, this has got the same stuff in it. This has got the same, like, ethylene oxide. It's not good.
Yeah. Well, I don't know. I got to cover the FOMC meeting right now.
Okay.
So it might be better to do that later.
Well, if you want to, it's going to take 15 minutes, so just do the swab.
Nose?
Yeah. Nope, wrong side. Wrong side. Pull it out.
I'm a genius. All right, guys. Market's still breaking down here. Breaking down. All right. All right, I'm back. Sorry, I had to swab my nose. I'm getting tested for the flu. We're being ultra safe here. 940s right now in the NASDAQ. Is it time to buy the dip? Remember, guys, the dot plot represents an average of all the different, or the dot plot shows you where the Fed members voted in terms of what they think the forecast what they think the Federal Reserve rate at the end of the upcoming years in the long run are going to be. And so, like, here's an example of one right here. If we want to look at, like, the dot plot to see kind of an update here. Here's an example of one. So you can kind of see, if you've ever watched The Office where they put a bean on, like, who they think should be the next boss, this is basically what they're doing with the Federal Reserve decision here regarding interest rates and where they think the federal funds rate is going to be in these years, you know. And so what you want to look for in the dot plot is like big clusters. You know, that's going to be probably closer to where it's going to be, because that just shows that the most people are voting on that. And this is just a piece of the Summary of Economic Projections SER report. Yeah, market closed normal time today. Yeah, I was going to use the wrong end of the Q-tip.
Here, why don't you blow your nose?
I deserve it right now. I deserve this to be positive based off of that. I'm fine. I'm not sick at all. I feel great. You know. All right. All right. So Nasdaq's breaking down. We're at 947s. SPY at 598s. And again, let's talk about this. So, the biggest stories of today's FOMC meeting. Fed is forecast to keep rates where they are now, which is at 4.25, 425 basis points, or 450 basis points, or 4.5%. Basis points just means decimals of a percent. And so the Fed is forecast to keep rates the same. 99.9% likelihood of a pause again today. And this is going to be the fourth consecutive pause. Basically, the Federal Reserve paused for like a year straight in 2023, all the way into 2024. And then at the end of last year, in September, November, and December, they did 50 basis points in September cut, 25 basis point cut in November, and then another 25 basis point cut in December, reducing interest rates a full percentage point, because 50 plus 25 plus 25 is 100 basis points. That's 1%. But then since then, even though we've arguably had weaker economic projections and data since then, we haven't cut it all. Now, I'm okay with maintaining price stability and maintaining a little bit more restrictive or hawkish in terms of interest rates. I've said this a million times, but I'll say it again. I would rather us go into a mini recession than have inflation get worse again. And so I'm okay with waiting. But I think we just need to be very cautious, like, with waiting too long. And so that's kind of where I'm kind of in the middle. I don't really agree with Powell. I think you could probably argue a 25 basis point cut today. But at the same time, you know, I think maybe he could balance it by ending QT, which is a less restrictive action. And then it's fine if he ends QT and pauses today, or if he cuts 25 basis points and continues the QT that we've been doing. That's fine because it's balanced, and it helps restrict. What I don't want to see is the Federal Reserve start to do quantitative easing, which is printing money and then using that money to buy up online, or to buy up. They create money through online, like digital Fed money, and then they use that to buy up a bunch of bonds and other mortgage-backed securities. And this is like one of the root causes of the inflation that we got in 2020, as well as like supply chain restraints and other stuff happened back then in 2020 that obviously stimulus checks, supply chain problems, a lot of quantitative easing, and then we brought rates to almost zero. And so all of those four things combined, the outcome is going to be inflation. But I think we've had enough inflation, and now we have to pivot to kind of the other end of it. And so we'll see what they do today. Again, we're going to pause today. I'm curious if they're going to update us on what they're doing with QT. Last time, or the time before last, they reduced their quantitative tightening by 80% in treasuries, and then they kept their MBS QT the same. So I'm really curious to see what we're going to get. And okay.
So, alright, I'm gonna go with that.
All right. Thank you, baby. Love you.
Love you. Just try to wipe your nose out and get that stuff. It's got.
Yeah. Yeah.
it's
Here.
gross.
Yep.
Yeah.
All right. Love you.
Love it.
Well, I mean, whether it worked or didn't work, like if we look at the Fed funds rate, or we look at CPI inflation is what I always like to look at, because the graph is really nice. You can take a look at the graph, and you can even look at it parallel with, you can look at the graph. You can also look at it parallel with the Fed funds rate and see, like, here's 2020. If you want to see how much it did save us from a looming recession. And people are very difficult in this regard, because if we didn't cut rates, if we didn't do QE, people would be complaining that the Fed's not doing anything, kind of like right now, right? If we didn't do QE and you know, economic stimulus in 2020. And so it's very nuanced and difficult to please everybody, especially if you're Powell. But you can kind of see it did help us rebound a little bit back up, along with like supply chain rebound. Like the supply chain problems got better very quickly. That helped GDP. That helped a lot of different things. So it's nuanced for sure. But you can see here, 2020 was right here. This is inflation, CPI, consumer inflation. We did all this economic stimulus, rate cuts, and all this stuff, just in some people's minds justifiably so. But the consequence was inflation spiked up to this crazy high level of almost 9%. And this is the reason people are still unhappy today. Like they had a survey that came out this morning that talked about how people are the least optimistic about financials right now since 2008. You know, so some of the survey results showed that people are the least optimistic financially right now. And this is why, right here. If you look at over here, like this CPI spike right here, almost 9%, because prices don't go down, they slow down. And you can kind of see with all the hawkish, restrictive monetary policy we did, prices did eventually slow back down to relatively normal rates. But the prices rose 2-3x in a lot of places. And so people are just still unhappy about those price rises. And, you know, we kind of need some sideways inflation years to stabilize things, I think, still. But that's where tariffs come in, because Powell is worried that tariffs are going to make inflation worse. And so that's the only reason in his mind that they haven't cut rates. They're taking a very data-dependent approach, and I think that's probably what we're going to get today, a very data-dependent approach. We're going to look at the update in the dot plot economic projections. We want to see how many cuts they think we're going to do this year. Last time it was 2. If they reduce it to 1, I think we're going to get a negative reaction to it. But who knows? We might not. Yeah, I mean, look, I'm biased for sure, you know, and I get it. Like when I say this stuff, and I'm not against the current president. I'm not really supportive either. I'm very neutral on all this stuff, and I kind of have to be. But even how I really am, I'm very neutral. So I'm not attacking you, and you don't want to pivot to that mindset of like, you know, anytime I disagree with somebody, I'm just the enemy. You know, that's crazy. You just want to be reasonable. And again, I agree with some of the stuff he does, and I disagree with some of the stuff he does, and some of his stances on things, and that's normal. Everybody mostly is right in the middle, you know. If you get too radical on either side, it just doesn't make sense, right? And this is most normal people, and so I'm pretty middle ground, moderate, you know. Anyways, today we get the dot plot updates. Yeah, the dot plot is going to appear. Median Fed funds rate is updated, so we can look at that to see what we're looking at. I mean, that's crazy, Jimbo. I'm not getting involved with any of that. Yeah. I didn't even say anything about like foreign policy. I didn't say a word about it. Again, I'm pretty, you know, neutral. I don't. There's a lot I don't understand about foreign policy, and so, you know, I'm gonna respectfully decline to comment on that. there should be a rate cut. I think you could argue 125 basis point cut today. I think you probably could. I think we've seen it's tricky. It depends on which data you look at. Like I cover all the major economic reports here, and so it really depends on which data point you look at to argue a rate cut today. If you look at like the middle of April, GDP, all that scary stuff, they're thinking we're going to be negative GDP. I think it was negative 0.3% was originally there, and then I think they updated it last time to they think a negative 0.2%. That does show a negative GDP expectation. That's weakness. The Fed now GDP has shown some contractions, but then it also showed some pretty big rebounds back up. Some of the inflation data has been good, especially the last like 3-4 weeks, month of inflation data has been optimistic. Some of the ones before that were not really, and so it really depends on which data point you look at. Again, I think if we maintain balance, we could argue a 25 basis point cut today if we continue QT, which is a hawkish thing, but reduce rates 25 basis points for balance. I think that's fine, but everybody's different, and it's so subjective. Depends on what you fear more. I personally fear inflation a lot more than economic weakness, but again, that's because I have my own selfish, like I want my own things. If I was a lender right now, I'd certainly be yelling lower interest rates, If I had a mortgage right now, I'd be yelling low interest rates probably so I could refinance. So it depends, In QT, it'll be fine. Yeah, I mean, I kind of agree with that to a certain point, Yeah, I mean, the market's going to pause today. Anybody that thinks we're going to cut rates today, they just don't understand what they're talking about. When I say I think you could argue a 25 basis point today, I'm not saying I think they're going to cut rates 25 basis points. What I'm saying is I think a 25 basis point cut could be justifiable today. Almost certain that we're not going to, though. 99.9% likelihood of no cut today. And so I would just not expect a cut because we're not getting one. Yeah, a few weeks ago, JP Morgan thought the S&P, the NASDAQ would break all-time highs within 2 weeks. This was 2 weeks ago as well. We didn't quite break all-time highs. I think something that happened was the conflict that pushed markets and oil up and markets down. I think if we didn't have the current Middle Eastern conflict that sprouted up over the last few weeks in terms of intensity, I think we might have been testing all-time highs right now. But because of that, it kind of kept us down a little bit more. Oil spiked, of course, but if we take a look at a daily chart on the SPY, we're pretty close. We're pretty close. Like we're not super far away. I got it at 100. Should have grabbed the IPO. Yeah, y'all talking about Circle. Circle's been crazy, honestly. Obviously, I wish I'd have got in too. Things at almost 180 right now. The last really good IPO I got in was ARM. I got an ARM at like IPO price, like basically right where it opened. It's at 150 now. It was like 60 is where I bought it or something. I sold when we got to like like 130. It's at 140 now, so I could have made a little bit more, but I'm happy with that gain. Apple's ripping up right now too. Apple up to almost 197 here. All right, guys, Circle up to 180s plus. We got the FOMC meeting at 2:30. The actual accompanying decision at 2 p.m. in 12 minutes. We'll see what we get. I'm curious. I want good things, but you never freaking know. All right, guys, 11 minutes here. 11 minutes. most people expect the rate decision to be a pause, right? So we will get the updated dot plot projections, though, at 2 p.m. So it's a little bit more important than a normal, just really obvious 2%, than a normal obvious 2 p.m. release. But, listening to what Powell says during the press conference is still going to be one of the more important things. We'll see what they do with rates, though. Yeah, we asked people how many rate cuts do we get this year. 33% think we're going to stay the same at 2, which is what they projected in March. 32% of people think we're gonna get 1 cut, so they're gonna reduce the amount of rate cuts we get from 2 to 1 today. And 30% of people, a third of people, think we're gonna get no rate cuts, which I find a little odd. I think that's a little out there, All right, guys, we got 10 minutes left, almost exactly 10 minutes. As long as he said something new, I'm good. Tired of him saying we can't wait or we can wait. Yeah, I mean, I hate to break it to you, but he's probably not going to say anything new. He's going to say, I don't know, data dependent. We'll have to wait and see. We've shown signs of inflation cooling, and that's good, but we still got to wait and see approach. He's going to say inflation is still above the Fed's 2% inflation goal. He's going to say dual mandate, basically that the Federal Reserve has a dual mandate of price stability and strong labor market. And so that's almost certain what he's going to say. What color will Powell's tie be is a different story. I don't know. We'll have to wait and see. Powell's tie is purplish. Yeah, usually it's purple. All right, guys, we got 9 minutes. Nasdaq's rebounded back up. Here's oil, $73 a barrel currently. Gold, $3,400 an ounce. I think surprise rate cut. You're wrong. We ain't cutting rates today, brother. I mean, maybe listen, I'm going to put this up there just for safety purposes. Not an investment professional. I might have no idea what I'm talking about. I might be wildly wrong about anything and everything I say. Do not copy me. Not an investment professional. Not liable if you lose money. Make your own assessment. Trade smart. I can't guarantee a freaking thing here. Now, with that said and out the way, though, we're probably not cutting rates today. It's 99.9 likely that we're not going to cut rates today, that we're going to pause. We're going to keep them paused until September. Here's the current odds of rates. Look, 99.9% chance of a pause, 0.1% chance, and this is almost always right, especially if you look at it 5 minutes before the meeting. I'm not expecting a rate cut, but in an unlikely situation, if the Fed cuts 50, what will happen? The market probably would panic initially, might stabilize into more optimism, but it would probably initially go down. But you never know. It might spike up. And to a certain extent, the market wants rate cuts, right? They want stronger economy, lower rates. I would say that's probably their priority over price stability and inflation. So probably, but you never know. We're live streaming all of it, Mythic. We're live streaming the release at 2 p.m. We're live streaming the accompanying press conference at 2:30. We're going to live stream all of it. If there's a rate cut, John goes streaking. I don't know about that. I'm not that confident, All right, guys. Nasdaq's popping back up. We're over 22,000. SPY up to 600s. Again, really important level on the SPY right here at 600. We're over 22K, though, on the NQ, which is good. We got about 6.5 minutes left. 6.5 minutes. Yeah, we're going to cut probably September is what it's looking like right now. Like, if you take a look at these rate odds, the only time this pivots to a change is September, right? As of now, we got about a 55% chance of a 25 basis point cut by September. If you combine the 50 and the 25, it's looking about 65 point something percent likelihood of a. It's looking about 65% likelihood. Yeah. So yeah, if you combine, we got about a 65% chance of a cut, any size cut by September. So we'll see. It's still improbable we're going to cut July. All right, guys, so we're here. We still got about 6 minutes left. A little bit over 6 minutes. Or a little bit under 6 minutes, I mean. But all right, guys. 5 minutes left. 5 minutes. We got overseas stuff going on. So almost exactly 5 minutes. Hit the live button next to the play button. Make sure you're fully caught up so you can digest everything when it comes out. There's inflation. I mean, there's 3% inflation roughly in yearly. Roughly 3%. Now, it might decrease month to month, but there's inflation. All right, guys, we're over 22,000, which is good. Do you guys think we'll get a bull or bearish reaction to this? Put the number up in chat. Bull or bear right now. Let me know. 4 minutes left, chat. 4 minutes. We're going to do a full countdown. All right, guys. Be ready. We got the FOMC decision and speech going live. 3 minutes and 3.5 minutes right now. I'm having to drink coffee. I tested positive for the flu this morning, so I appreciate you guys joining me here anyway. We're doing our best, but here we go. All right, we're pushing up. We're at 2250 here, 2250. SPY up to almost 600. Remember, the rate decision's at 2 p.m., so we got 3 minutes almost exactly right now. 3 minutes. I don't know what we're going to get. I think we're going to... How many rate cuts do we think we're going to get this year? I'm expecting 2. I'm expecting 2. I think we're going to do one. We're either going to do one and then another one in November, or we're going to do one in September and one in December, personally. But I might be wildly wrong there. I really genuinely don't know. We got 3 minutes left. All right, guys, we got 2.5 minutes left. 2.5 minutes. Hit the live button next to the play button. Make sure you're fully caught up on the stream chat. I appreciate it. The rate decision's at 2 p.m. If you put it in 2x speed, it'll also catch you back up. Again, most important thing, we got to look at the dot plot. All right, we're preparing for this here, chat. The last one was 319. Today's is going to be 618. All right, guys, 2 minutes left. 2 minutes. Two minutes. A minute and a half. Chat, a minute and a half. Yeah, it looks like most people think we're going to get 2. Like, most people agree with me in that regard. A minute and 20 seconds, chat. A minute and 20 seconds. A minute and 10 seconds. All right, guys, let's watch gold. We'll watch the SPY, and we'll watch the NASDAQ to see this. All right, we got 1 minute left, chat. 1 minute. All right, remember, we got the updated dot plot today. That's the first thing we're going to be paying attention to. The first thing. All right, the timer's a little bit early. Don't worry about it. We got 45 seconds. Hit the live button next to the play button. 45 seconds. All right, guys, we got 25 seconds. 25. 20. We're going to do a full 10-second countdown here for this rate decision. 15. Be ready. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. And here's the report. All right, so we got a FOMC pause. They paused interest rates. They didn't change them. They paused interest rates. All right, so we're looking at the economic. We're going to give you guys the fastest reading of this summary of economic projections and dot plot reading here. So we're going to give you the fastest reading of it. We're having AI analyze this or not right now. We already got the page up. And bear with me. We are going to give you the fastest. But we paused rates. Okay, so NASDAQ is up here. NASDAQ is up. Okay, so for June 18th compared to the previous March projections, federal funds rate projections, dot plot, 2025 medium rate at 3.9%, unchanged for March. That means they think we're going to have 2 rate cuts this year. 26 medium rate, 3.6%, up from 3.4% slightly here. Slightly. So it was 3.6% today. Last time it was 3.4%. So they updated the federal funds. A little bit more hawkish of a report here. The 2027 medium rate came in at 3.4%, which is up from 3.1%. So they think longer run, we're going to have higher rates for longer. Basically, the new median for 2025 is 1.4%. March median is 1.7% for 2026. So basically, 1.4. They think we're going to get 1.4% cuts on the median is for 2025. Oh, no, this is GDP. I'm sorry. So the GDP for 2025 is 1.4%. New median. March, it was 1.7. So it decreased a little bit for this year. The GDP growth, real quarter 4 versus quarter 4. 2026, they think 1.6% versus 1.8% last time. So most of the GDPs were either the same. 2027 was the same. Longer run was the same at 1.8% for 2027 and longer run. But 2026 GDP was forecasted down to 1.6% for quarter 4 real. 2025 quarter 4 came in median 1.4% versus 1.7% last time. So it was revised down. The Fed trimmed 2025 and 2026 growth outlook slightly due to softer consumer and business demand forecasts. The unemployment rate, the new median is now 4.5%. It's up a little bit this year from 4.4% last year in the dot plot. Look, I'll show you guys this here. 4.4% for 2027. So you can kind of see we slightly higher unemployment expected across the board reflects tightening credit and labor market softening. And this might be what the market's reacting to here. They might just be digesting this. Inflation looks bad here, Chad. So look at this. 3% versus 2.7% in March. 2.4% for 2026 versus 2.2% in March. 2.1% for 2027 versus 2%. Longer run at 2% is even. Core PCE, which is the more important one, increased 3.1%. Chat, 3.1%. 2026 increased as well. 2027 increased as well here, chat. So it ain't good. It ain't good. I'm surprised the market originally reacted positively. The Fed sees higher inflation in 25 and 26 than previously forecast, suggesting slower disinflation and less room cuts. Fed members overwhelmingly see higher than usual uncertainty around GDP, inflation, and employment. Again, we pause rates as we told you guys we would. We'll put this up on screen. But weaker dot plot, honestly. Like noticeably weaker dot plot. Yeah, so we're going to put this data up on screen. Here is the updated visuals. And again, the market's down here, chat. Market's down. Again, worse GDP, higher inflation projections in the dot plot, although the rate decisions did remain the same. So the rate decisions did remain the same. They didn't move. All right, so NASDAQ is down. Gold is up. SPY is down to 599s. Again, we kept rates unchanged as we told you guys we would. Oh, no, I'm sorry. So they did change it. So the federal fund rate holds at 3.9%. There's only one cut expected versus March. So that is actually something I got wrong. There's only one cut expected versus March, I think, according to this data. So, and again, we can look at this data here. Yeah, I'm showing 2 rate cuts. Maybe this is an AI mistake. Let me confirm this. All right, so we are down. The medium 2025 Fed funds rate in both March and June is 3.9%, but in March, more members had dot plots below 3.9%, suggesting 2 cuts from 5.25 to 4.875 to 4.625. In June, fewer members see cuts below 3.9%, with more clustering on above. Yeah, so basically 1 basis point cut is what they're now showing here. And again, I'm going to list this all on my x.com page at Beginner Trades. At Beginner Trades, give me a follow. Also, check out Top Step. Top Step, a beautiful way to learn how to day trade. Most day traders lose. And so if you fund your own account thousands of dollars, you're probably going to lose. It's a better way to learn how to day trade in the context of a funded account program, because most day traders lose money regardless of where you go. And so if you fund your own account thousands of dollars, you're probably going to lose it. Instead, try Top Step. They give you a 50K demo. They test your skill with it. If you pass the test, they fund you. If you fail, you only lose what you pay for it. The base one's $50. So it's limited risk, 90% split once you're funded. So very similar to funding your own account in terms of split, but the risk is less. They pay out millions. Use Top Step X. You get 0 commission, no PDT in futures. It's just a beautiful test of skill, teaches you how to trade. And I'll put the link up. They are an affiliate or sponsor of mine. I'm biased because I get paid by them. Understand all this stuff on screen. I can't guarantee anything. There's the link right there. I'll put it to the top of the chat as well if you want to check it out. I'm showing 1 potential rate cut this year. Is what I'm showing. But again, you never freaking know. $2:30 p.m. Stick around. 2:30 p.m. All right, so we are rebounding back up to that 2,000 limit. Let me check to confirm. All right, so we are rebounding back up. All right, so markets, again, we'll give you guys another update of this. Again, GDP reduced from 1.7 to 1.4% for 2025. Fed fund rate hold at 3.9, only 1 cut expected in March versus in March. Two cuts. They raised 2026 to 3.6% from 3.4%, and they raised 2027 to 3.4 from 3.1%. Long run rate is unchanged for the Fed rate outlook. GDP got worse. Projections 2025 down to 1.4% from 1.7%, 2026 1.6% from 1.8%, 2027 1.8% unchanged, and long run is unchanged as well. Unemployment got worse, projections as well. 4.5 versus 4.4 last time, 4.5 for 2026 versus 4.3 last time, 4.4 versus 27 versus 4.3%. Long runs at 4.2%. Inflation is expected to get worse. Projections as well here, 3% versus 2.7 this year, 2.4 from 2.2 next year, 2.1 to 20 from 2% in 27, and 2% unchanged target. Core PCE was basically the same. Yeah, and again, we're going to give you an update at Beginner Trades if you want to. We're going to put this out right now just so people can see what the odds are for this. All right, so yeah, we just posted that update on x.com at Beginner Trades. Yeah, we got a timer coming out. Let's do it here. We got 19 minutes left, basically. Here's the timer right here, right side. Yeah, I don't think they're going to raise, but who knows? You never know. Again, stick around. We're going to cover the full press conference live as it happens as well here, chat, so stick around. All right, so amid escalating tensions between Washington and Tehran, U.S. President said that Iran reached out to his admin and expressed its willingness to negotiate without ruling out a strike, according to some other news sources here. All right, so we slowly reacted negatively to this report. I'm really curious to see what Powell says during this press conference as well, though. So that news came out. Yeah, and again, I can put this up. Like, this is the outlook from this report. 25, only one cut expected versus 2 in March. They raised 2026. Interest, like, more hawkish for sure here. Short term next year, they think at 3.6 versus 3.4%. They raised to 3.4 from 3.1 for 27. Long run, unchanged. GDP went down. Unemployment rate went up in terms of projections. Not went up, but they're projected to go up. Inflation went higher. Yeah, inflation went higher. Core PCE was higher. Only one rate cut expected this year in 2025. Inflation remains sticky. That's basically this report today. Now, we still got the FOMC meeting coming live in about 18 minutes, but it ain't looking good, chat. It's not looking good. No, there's no rate cuts. Again, if you read the big yellow letters, the Fed left rates on hold at 4.25 to 4.5% as expected. 25 dot plot unchanged at 3.9%. 26 revised higher to 3.6 from 3.4. Yeah, so the dot plot wasn't changed, but what changed was the distribution of dots. Fewer policymakers projected rates below 3.9%. Most of the dots clustered at or above 3.875%, just to clarify. So All right, we got 15 minutes into the FOMC meeting, Chad. 15 minutes. All right, so we're starting to rebound back up here, but we still got a ways to go. We pump? Yeah, I don't know. Yeah, so here's the updated dot plot. Yeah, I see most clustered between 3.5% to 4% for this year. Yeah, so this is the FOMC dot plot update. Here. And you can kind of see they expect this year to be more hawkish than next year. And they expect it to kind of slow down the hawkishness by 2027 and beyond, but we'll see. Very small reaction here. Not really much of a big reaction here. We didn't really get much. I appreciate everybody that followed me, though. Shout out to you guys. And so again, the dot plot and the summary of economic projections seemed a little bit more hawkish to me. We'll see, though. What do you guys think he's gonna do here? So I'm gonna end this poll. We're gonna do another poll. Will Powell's tone be hawkish or dovish during this meeting? Vote in the poll. There it is live. I think Powell will be hawkish. I mean, the report was hawkish, I would argue. The report's hawkish. I mean, honestly, the market's very flat on this. Like, we barely moved here. Like, for an FOMC decision, and especially for a dot plot update, this is honestly pretty consolidated reaction. Like, this isn't much here. Like, this is not much. So, interesting nonetheless. But it's not a huge reaction, to be honest. He'll probably have a purple tie. Yeah, the market's probably flat, waiting on him to speak. But we got updated projections. Look at the NASDAQ rip. SPY bouncing back up a little bit. Q is up on this candle, but still very muted reaction to the Fed meeting. Gold's pushing up. Still a little ways from all-time highs here, but still pushing up nonetheless. So you're telling me the market can still boom even after a pause on this meeting? Well, King, everybody already knew we were going to pause during this meeting, brother. It doesn't make any sense to me if everybody knows an outcome is coming. And then when that same outcome was announced, the market somehow goes up. That doesn't make any sense to me. What's really going to make the market boom or bust is Powell's tone during the press conference, like what his answers to the questions he gets versus his tone, or as well as his tone, I should say. That's going to matter more. And then the economic projections matter, but and so that's probably why we're down a little bit, is because we reduced the rate cut odds this year a little bit, at least in terms of the Fed voters, from 2 to 1, even though the Fed funds rate left was basically the same. First move's usually the wrong move. Yeah, we originally reacted positively. Yeah, all good, King. Yeah, I don't know if he's going to say the economy's good. I think he's going to say inflation is still elevated and it's a risk. And the labor market is resilient is usually what he says. He says something like that. Like labor market, resilient, inflation risky, dual mandate, strong labor market, low inflation, price stability, whatever he wants to say. And so that's what I think he's going to say. I think he's going to say that the labor market's resilient and they got a dual mandate. All right, so we're now dipping down here. We're at 22,000, 21,996,000. Yeah, dual mandate, data dependent approach. He's going to say something like that. We're slightly hawkish. There's gold. We're at 3,400s here. All right, guys. We got 9 minutes until the FOMC meeting starts. 9 minutes. See, what's very strange is like, look, I took another flu test, and it was negative. This is 2 negative tests to 1 positive, but I feel like I don't feel good. What do you guys think it is? Do you think I have it or don't have it? All right, we're up to over 22,000 here. Gold at 34s. SPY at 599s. Circle ripping up. Arms pushing up. They say the U.S. Embassy says mission personnel begin departing Israel. I'm negative for everything else. I took everything else. I've got the flu, it says. Or at least one test said. I would assume a positive test is pretty, you know, that's the like. If I get one positive test, even if the others are negative, it's still pretty probable, especially if I feel like crap, right? All right, so we're starting to break down. We're at 21,995s here. Again, chat, stick around. We got 8 minutes. We're going to stream this full thing live as it happens here. We're here. We're ready. Sorry. Sorry, I'm trying to put this up so we can watch it. All right, chat, we got 7 minutes here. 7 minutes. All right, so I need to zoom out a little bit. I'm trying to get it perfect for you guys, so bear with me here, chat. I'm trying to do you guys a service here. You're welcome. Oh, messed it up. There we go. We'll leave the SPY up there. Stretch this out here. All right, there we go. Give you guys a clean chart. All right, guys, we got 5 minutes left. 5 minutes. I'll put the regular NASDAQ up here too. We got the SPY underneath you. Let me maybe reduce this some. What do I want to do here? I could probably pull this up. Maybe reduce this some here. Hold on. Do I fit this? That's pretty good. There we go. That way the SPY can be seen here. There we go. And then maybe I can bring this down like that. I think that's pretty good. All right, so here's the NASDAQ here. We got the NASDAQ 100 on the left side. We got the SPY below this. Yeah, and we got 3 minutes, 4 minutes left. Looking at the poll numbers here, 66% are hawkish on this speech. Yeah, we're ready here. Again, 66% of people are hawkish. The rest are dovish. 34%, 35%. US debt too high, no QE. SPY starting to push up. Yeah, all good, Cosmo. All right, chat. 3 minutes exactly. 3 minutes exactly. We're going to get multiple speeches up here just so we can catch the fastest one for you. Put that one up if we need it. This is usually the faster one, but we'll keep that one on standby just in case. Powell's tie is going to be purple. It's going to be like a light purple. It's going to be like a... It's going to be like a mauve. Or a mauve. It's going to be like a mauve color. It's going to be like light purple, like lavendery purple. I just know this, you know. All right, chat. Hit the live button next to the play button. Make sure you're fully caught up on the stream, chat. We appreciate it. Hey, what's up, Larry? My guy. What's up, bro? All right, we got the FOMC rate decision, a minute and a half, chat, a minute and a half. Here, I'm going to mute the music, and I'm going to turn it all the way up so you can really hear it. But just listen, when the press conference starts in about a minute, let me know if it doesn't come in good. It should be perfect, but if it doesn't, let me know. Yeah, I got to unmute this so I can really catch it for you guys. Okay. I got the faster one up here. You're welcome. This one's a little bit quicker. But whichever one comes in first, we're ready for it here, guys. All right. 15 seconds, 15 seconds. We're going to turn this timer off.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I'll have more to say about monetary policy after briefly reviewing economic developments. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP as we call them, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.4% this year and 1.6% next year, somewhat slower than projected in March. In the labor market, conditions have remained solid. Payroll job gains averaged 135,000 per month over the past 3 months. The unemployment rate, at 4.2%, remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.5% at the end of this year and next, a bit higher than projected in March. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.3% over the 12 months ending in May, and that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 3%, somewhat higher than projected in March. The median inflation projection falls to 2.4% in 2026 and 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to trade, immigration, fiscal, and regulatory policies continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year, the same as projected in March. The median projection declines to 3.6% at the end of next year and to 3.4% at the end of 2027, a little higher than the March projection. These individual forecasts are always subject to uncertainty, and as I've noted, uncertainty is unusually elevated. And of course, these projections are not a committee plan or decision. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on issues related to assessing the risks and uncertainties that are relevant for monetary policy and the potential implications for policy strategy and communications. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference that we held last month. We are open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up any modifications to our statement on longer-run goals and monetary policy strategy by late summer. After that, we will consider enhancements to our suite of communications tools, including the SEP. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Colby. Thank you. Colby Smith with the New York Times. To what extent has the more limited impact from tariffs at this stage on inflation changed your view on what the ultimate economic fallout will be from these policies and the timing of when they will materialize in the data?
So we've had 3 months of favorable inflation readings since the high readings of January and February, and that's, of course, highly welcome news. Part of that just is that services, core services, both housing services and non-housing services, have really been grinding down toward levels that are consistent with 2% inflation. So that's the good news. We've had goods inflation just moving up a bit, and of course we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months. We do also see price increases in some of the relevant categories like personal computers and audiovisual equipment and things like that that are attributable to tariff increases. In addition, we look at surveys of businesses, and there are many of those, and you do see a range of things, but many companies do expect to put all or some or all of the effect of tariffs through to the next person in the chain, and ultimately to the consumer. Today, the amount of the amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more. And we think our policy stance is in a good place where we're well positioned to react to incoming developments.
So in terms of how we should interpret the rate cuts penciled into the SEP, is this reflecting that there's this expectation that underlying inflation will just stay well enough contained that allows the committee to eventually move ahead with those cuts? Or is it about responding to a deterioration in economic activity, let's say? I mean, how should we make sense of the forecast?
So if you look at the forecast, you will see that people do generally expect inflation to move up and then to come back down. But we can't just assume that. Of course, we don't know that. And, our job is to make sure, one of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping inflation expectations anchored.
Hi, and thanks, Chair Powell. Howard Schneider with Reuters. If you look at the rate path starting in December to today and adjusted over the full time horizon you've got there, you've taken about a quarter point per year out of your projected path, and you end at a higher rate at end 2027 than you would have in the prior forecast. Is that a result of a sense that tariffs will lead to more persistent inflation? Is it a result of reassessments of where your short-term neutral rate is? Why are you on a slower path now?
So I would focus most on the nearer term. As you get out to the later years, it's hard for anybody to know where the economy is going. You didn't see people moving their longer term, estimate of the neutral rate, for example, at this meeting. So and those things are probably slow moving. So I think if you look at what's happening here since March, this is since March, right? You see a little slower growth, just a tiny tick up, a 1/10 tick up in unemployment, and you see inflation moving up 0.3. And by the way, it was a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April, after the March meeting, that substantially higher tariffs were likely. And then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time. And what you see is an accumulation of individual assessments.
You say in the statement that risks have diminished on that front, but the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East adversaries with a possible U.S. involvement. How can you justify saying that risks have diminished?
So what we said was that uncertainty uncertainty about the economic outlook has diminished but remains elevated. Many surveys say that. They do. So, and that's actually a line from the Teal book, which you can see in 5 years. Remember to check that.
Maybe the world will be over by then.
No, but if you think about it, tariff uncertainty really peaked in April, and since then has come down. And that's really what that's just acknowledging. It's diminished, but still elevated. That it's uncertainty. So I think that's an accurate statement.
Chris Rugaber.
Thank you. Chris Rugaber at Associated Press. There is an argument out there in favor of cutting rates more immediately. Inflation has continued to cool and is back to roughly 2% despite the tariffs. And I guess I also wanted to ask about cracks in the job market with gross hiring slowing, concentrated in just a few industries. We've seen some housing data, including this morning, that have been pretty weak. Do you see any concerns that, the economy is weakening and that is a reason to cut rates going forward?
So we do, of course, monitor all those things. I think if you look at the overall picture, what you're seeing is 4.2% unemployment and an economy that's growing at a rate hard to know given the unusual flows in the first quarter, but it appears to be 1.5%, 2%, maybe a little better than that. Sentiment has come up off of its very low levels. It's still depressed. So, you can point to things. The housing market is a longer run problem and also a short run problem. I don't think it's indicative of, basically the situation is we have a longer run shortage of housing, and we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a sustainable way and create a strong labor market, and that's the best thing we can do for the housing market. You asked about the job market. Again, look at labor force participation, look at wages, look at job creation. They're all at healthy levels now. I would say you can see perhaps a very, very slow continued cooling, but nothing that's troubling at this time. But we watch it very, very carefully. So overall, again, the current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments, and for now, and we'll be watching the data carefully.
Well, just quickly on, given that, there are concerns inflation will rise, but there is the alternate scenario that tariffs would create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do you see odds of that scenario? What kind of odds do you see of that scenario coming true, and how many months of cool inflation would you need to see before concluding that maybe that lower inflation scenario is taking place?
So this is very much the conversation we had today and yesterday. There are many, many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we think, and where the labor market does or doesn't soften. And I think what you see people doing is looking ahead at a time of very high uncertainty and writing down what they think the most likely case is. No one holds these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for any of the rate paths, I think, that you see in the SEP. And we do this once a quarter. It's a hard thing to do particularly at this time, but it does reflect. If you see somebody writing down a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts will be appropriate. And it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
Thank you. Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast are very high. How do you get to a place where you have the confidence in the outlook for, say, inflation and or growth or the unemployment rate? How many months does it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we're going to learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see to the extent to which they do over coming months. And I think that's going to inform our thinking, for one thing. In addition, we'll see how the labor market progresses. So at some point it will become clear. I can't tell you exactly when that will be. And meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength, and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know with any confidence where they will settle out. We have an estimate, and I think all estimates are now pretty close together, but it's highly uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? And could you share that?
What you start with is what's the effective tariff rate overall, and people are managing to that. But the pass-through of tariffs to consumer price inflation is a whole process that's very uncertain. As you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer. And each one of those is going to be trying not to be the one to pay for the tariff. But together, they will all pay for it together, or maybe one party will pay it all. But that process is very hard to predict. And we haven't been through a situation like this. And I think we have to be humble about our ability to forecast it. So that's why we need to see some actual data to make better decisions. We'd like to get some more data. And again, in the meantime, we can do that because the economy remains in solid condition.
Nick Tamarosa of the Wall Street Journal. Chair Powell, I guess I'm wondering if you could explain a little bit more the divergence we see in the dot plot, particularly around the 2025 rate projections. I realize this is, you have one group of officials that are putting down no cuts, another that are putting down more than one. And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook or a different reaction function, a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts. And they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down, more cuts. But remember, as we see more data, we're going to learn more about where inflation is headed, and that means when it is time to look at resuming our normalization process, the differences you see should be smaller because we'll have seen actual data. Right now, it's just a forecast in a very foggy time. So that's the first part, is forecast. Secondly, people can look at the same data and they can evaluate the risks differently, as you know. And that includes, the risk of higher inflation, the risk that it'll be more persistent, the risk that the labor market will weaken. People are going to have different assessments of that risk. So that you put that in there too. So those are the two ways that the two things I think that drive these things. Remember though, as I mentioned earlier, with uncertainty as elevated as it is, no one holds these rate paths with a lot of conviction. So that's really where it is. It's a function of those things. And I think as the data come in, you should see those differences diminish.
If I could follow up, you've said that policy is in a good place and that it's modestly restrictive. Given all the uncertainty you just talked about, tariff levels, uncertainty around the pass-through, is it price increases versus margin compression, some of the softness that Chris talked about in labor and housing, why wouldn't it be better to have rates at a more neutral setting as the economy heads into this period of very high uncertainty?
So if you just look backward at the data, that's what you would say, but that's not. We have to be forward-looking, and the thing that every forecaster, every outside forecaster, and the Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months, and we have to take that into account. So I think a backward-looking look would lead you to a neutral stance, but we can't. We have to look at that, and because the economy is still solid, we can take the time to actually see what's going to happen. There's a range of possibilities on how large the inflation effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass-through of inflation and what's going to be the effects on spending and on hiring and all those things.
Mr. McKee.
Michael McKee from Bloomberg Radio and Television. Your friend down at 1600 Pennsylvania Avenue continues to lob insults in your direction, and I'm wondering, given now that the Supreme Court has maybe carved out the Fed from some of the legal implications of that, whether this is just noise that the markets and everybody should ignore until your term is up, or whether you worry that it could lead to more pressure on confidence on Wall Street, on consumers, about the outlook for the economy.
Okay. From my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with strong labor market and price stability. That's what we want. We think our policy is well positioned right now to deliver that and to be able to respond in a timely way as the data lead us around. The economy's been resilient, and part of that is our stance. And again, we think we're in a good place on that to respond to significant economic developments. That's what matters. That is what matters to us. Pretty much that's all that matters to us.
I need to ask, assuming you are not reappointed, would you stay on as governor when your term as chair ends?
I'm not thinking about that. I'm thinking about this.
Andrew.
Thanks, Mr. Chairman. I guess with workplace raids picking up significantly, what kind of effect would that have on the labor market in
Sorry,
the short
with
term?
what picking up?
Workplace raids.
So you're asking immigration.
Yeah.
You know, I wouldn't want to speculate. One way to get at that from an economic standpoint, we of course don't comment on immigration policy. It's not ours to make or comment on. But what you see is an unemployment rate that has been really solid and at a low level, not really increasing. It's been in a good range and well within the range of mainstream estimates of maximum employment. And that means, like, part of that is that labor demand and labor supply are kind of moving down at the same rate. Labor demand is softening. You see that in job creation, but it's still kind of at a healthy level. And labor supply is diminishing because the immigration numbers that we see are much lower than they were. So those two factors, supply and demand, that's what has kept the unemployment rate in a reasonably stable place.
Okay, thanks. The other thing I wanted to follow up on is if you could elaborate on the potential changes to the SEP that you suggested were part of the framework review, I think.
So the framework review really has two tracks, right? The first track is our policy framework that is reflected in the consensus statement. And we've said that we would finish that and announce it by the end of the summer. So we're well along in that process. We've had the meetings that we need to have, and we're now going to be going into, into discussions about, specific changes to language. So that's the framework part of it. The second part of it is our communications tools and practices. Pardon me. And that part comes next. Okay, that's what we're going to do in the meetings this fall. Actually, what we did at this meeting, though, is we sort of prepared the ground for that. We had a meeting where we talked at a high level about a number of ideas. The SEP is part of it. Many other ideas. It's sort of how do we think our communications can be improved? There are a number of ideas. People offered a really, it was a great conversation, number of ideas, but we're going to look at those with staff briefing and a lot of thought in the fall. And I would say when it comes to changing communications, I would only support things really that only implement things that have very broad support. And also you want to be really careful because I think our communications are pretty well received. They're not broken. So more is not necessarily better, but better is better. So we're going to be looking at ways to do things that will improve the clarity of what we do for the benefit of the public.
Thanks, Chair Powell. Kelly O'Grady, CBS News. You're famously known as the guy that makes decision based on data instead of speculation. You've said today the inflation data is in a good place. We don't know how tariffs are going to impact prices going forward. That's uncertain. But I've got to go back to the last time that you cut rates in December, and there was still the what if of tariffs. So what made you feel comfortable cutting then when inflation was higher than where it is today, and you didn't cut today?
Well, the forecast for inflation in December was 2.5%. Core PCE for 2025, the forecast was 2.5%, which was a good inflation forecast. I think what we've learned is that, and this was long before we had any idea of what the actual policies would be, we've learned that the tariffs are going to be substantially larger than forecasters generally thought. And we don't, our forecasts are generally not particularly different from those of other well-resourced forecasting operations. So what we learned, and particularly in April, was that very substantially larger tariffs were coming and that would mean higher inflation. That's what happened. And so you saw 2.5% forecast in December, you saw 2.8% in March, and you see 3.1% now. So it's 0.6 higher inflation for 2025, and that's a big part of the change, and that's due to the effects of the tariffs that are, we don't know where they're going to land, but it's pretty apparent they're going to land higher than outside forecasters were really guessing at the end of last year.
My follow-up to that, I think consumers, right, we're looking for relief on rates when it comes to mortgages, car loans, small businesses want to take out more manageable loans. When you look at the cumulative inflation over the past 5 years, prices have risen over 20%. It's been a rough road. So what is the tipping point then for the wait and see approach in terms of how much it's going to help versus when it hurts the American consumer?
Well, I mean, we're trying to restore price. The best thing we can do for the public that we serve is restore price stability. If we can, and we will, restore price stability, meaning 2% inflation on a durable, sustainable basis, that, and also maximum employment. If we restore those things, that's the best thing, and that is our goal. The best thing we can do for the American people, for households and businesses, that is the ultimate thing that we can deliver. And they can make their decisions without having to think about inflation all the time. So in the meantime, we have to keep rates high to get inflation all the way down. They're not very high, let's be honest. I would say policy is modestly or moderately, probably modestly now restrictive. If you look at the economy, it's not performing as though it were performing under very strict monetary policy, very restrictive monetary policy. So I would say probably modestly restrictive. And so what it will take is confidence that inflation is coming down. Now, I would say without tariffs, that confidence would be building, because if you see what's happening with non-housing services and housing services, which are the other two big pieces other than goods, those are coming down really nicely now. So I think we have to learn a little more about tariffs. I don't know what the right way for us to react will be. I think it's hard to know with any confidence how we should react until we see really the size of the effects, and then we can start to make a better judgment. So that's what we're doing, and I think we can take the time to do that because unemployment is 4.2%. Wages are moving up. Real wages are moving up at a healthy clip now. And inflation is 2.3% headline inflation over a 12-month basis. So it's a good economy and a solid economy with decent growth.
Thank you, Chair Powell. So you're saying that uncertainty has come down, the economy is moving at a solid pace, inflation has come down over the past 3 months, and this is all moving in the right direction. So are you indicating here that Americans should expect some sort of economic pain in the second half of the year?
I'm not saying that at all. From our standpoint, what I can say is that the U.S. economy is in solid shape. Inflation has come down. The unemployment rate remains at 4.2%. As I mentioned, real wages are moving up. It's a good job creation is at a healthy level. Unemployment, again, as I said, low. Labor force participation in a good place. So, and what we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that. Every forecaster you can name who is a professional forecaster with adequate resources and forecasts for a living is forecasting a pretty significant. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs, because someone has to pay for the tariffs, and it will be someone in that chain that I mentioned between the manufacturer, the exporter, the importer, the retailer, ultimately somebody putting it into a good of some kind, or just the consumer buying it. And all through that chain, people will be trying not to be the ones who pick up the cost. But ultimately, the cost of the tariff has to be paid. And some of it will fall on the end consumer. We know that because that's what businesses say. That's what the data say from past. So we know that's coming. And we just want to see a little bit of that before we make judgments prematurely.
And follow up on that. So you spent years though talking about how you're data dependent, and be a little more direct on this. Now you're making decisions looking forward. Doesn't the data you're seeing today indicate there should be a rate cut?
No, I mean, your monetary policy has to be forward-looking. That is elementary. You've got to be looking. I always talk about the incoming data, the evolving outlook, and the balance of risks. We say that over and over and over again. Right, so it's always forward-looking. If at the very beginning of the pandemic, we cut rates to zero immediately. Nothing had happened. We just knew that it was going to be really bad, right? So we took very aggressive forward-looking because we knew things were going to be unusually difficult. So, of course, this is something we sort of know is coming. We just don't know the size of it. And again, the economy seems to be in solid shape. So the labor market's not crying out for a rate cut. Businesses, were in a bit of shock after April 2, but you see business sentiment, you talk to business people now, there's a very different feeling now that people are working their way through this, and they understand how they're going to go, and it feels much more positive and constructive than it did 3 months ago, let's say. So again, we think that our current stance of monetary policy is in a good place.
Thank you. Amara Mokwe with Bloomberg. Chair Powell, in February, you told Congress that the Fed is, quote, overworked, maybe not overstaffed. Then in a memo to staff in May announcing a deferred resignation program at the Fed, you said you wanted to ensure that the Fed was, quote, right-sized. Those two statements appear to be at odds with one another. Could you explain what changed in the roughly 3 months between those statements that made you decide that staff levels at the Fed should decline?
I don't see them at all as intention. So I was asked, is the Fed overstaffed? And I said no, and I sort of said as a pun, overworked but not overstaffed. People do work extremely hard at the Fed, and I know they work hard at Bloomberg too. So, but we work hard, but I would say this. So we are careful stewards of public resources, and sometimes you need to show that. So there have been several times in our history, modern history, where the Fed has said, you know what, we're going to do a buyout. We're going to show the public, we're going to demonstrate that we are good stewards of public resources. So we thought, and I thought, that this is a time when we can, we grow at about, our headcount has grown at about 1% a year. So over the course of a couple of years, we're doing a careful scrub of the board and all the reserve banks, and we're going to find 10% of employees who can do something else, where we can streamline our operations, and we think we can get there in a couple of years. We think we can do that, and we think this is without taking risk to carrying out our critical missions. So this is something you do very carefully, thoughtfully, and you do it again respecting that we have critical missions to carry out. I've had a lot of experience in my prior careers, with headcount reductions and things like that, and this is how you do it professionally. You do it carefully, thoughtfully, with a lot of planning, and you do it over a period of time. And I think the Fed will be fine. I think no one will notice any decline in our ability to carry out our missions, and I think it's just us wanting to demonstrate to the public that we are actually good stewards of their resources. We're effectively wiping out 10 years of headcount growth with this. So, I mean, we wanted to show that, that we're good stewards.
How is progress on reducing headcount going so far? Are you on track to meet the goal?
We're just at the very beginning. As you know, we're doing a buyout program. We're gonna hit that goal. I think many organizations find that they can do this. You don't want to do it every year or anything, but you can do it at intervals, and you wind up not interfering with your ability to perform your jobs.
Chair Powell, Claire Jones from the Financial Times. As you're no doubt aware, the Senate Finance Committee has tabled its version of the reconciliation bill this week, and I was wondering if you could tell me a little bit about the tenor of the debate at the FOMC over the past few days on fiscal policy and the degree to which that influenced people's projections for 2026 and beyond. Thank you.
Yeah, so, we don't sit around and debate or really discuss. We take fiscal policy as fully exogenous, and so we actually, really didn't talk about the bill or the contents of it. It's still evolving. When it gets closer, remember also we have a very, very large economy, and that the effects will be at the margin, I expect that they may already be in, but they will be in by the next meeting. We'll make an estimate, but it's not a major thing. It's nothing that we discuss. It may have been mentioned a couple of times, but as something that's coming in. But I think the outcome is, we don't know the outcome yet there, so hard to be real specific.
Neil. Thanks, Chair Powell. Neil Irwin with Axios. there have been some cutbacks in economic statistics collection in the last few weeks, and worries that long-running problems around funding and response rates may be getting worse. How much is this concern on your radar? How much confidence do you have that the gauges you're watching to assess the economy are reliable right now?
You know, two things. One, the data we get right now, we can do our jobs. I'm not concerned that we can't do our jobs. That's not the point. The point really is that we are starting to see, layoffs and important gatherers of data are saying that they're having to cut back on the size of their surveys. That's going to lead to more volatility in the surveys. I think we should take a step back and, from our standpoint, and I think the standpoint of businesses and governments and everyone, having really good data on the state of the economy at any given time is a huge public good. It helps, it not just doesn't help the Fed, it helps the government, it helps Congress, it helps the executive branch. More importantly, really, it helps businesses. They need to know what's going on in the economy. The United States has been a leader for many, many years in this whole project of measuring and understanding what's happening in our very large and dynamic economy. And I hate to see us cutting back on that, because it is a real benefit to the general public that people in all kinds of jobs have the best possible understanding of what's happening in the economy and hence what's likely to happen. It's very hard to measure what's going on in the U.S. economy. If you read, there was a book called, it's really remarkable how many things you need to understand to estimate U.S. GDP. Very, very difficult. And it's so important that we get it right. I just would say it's not a place to I would want to keep investing in that, for the good of the general public.
Victoria. Hi, Victoria Guida with Politico. So you're conducting this monetary policy strategy framework review, but next year we're supposed to have a new Fed chair. And I'm wondering if that affects at all the way that you're approaching this. How do you ensure that this framework will actually be durable?
The framework document goes back to 2012, and it's the committee's document. It's not like we're going to invent a brand new way to do things. It's been an evolving document, so it shouldn't depend on who the chair is at all. It should depend on what's happening in the economy and what the committee wants to do. So, yeah, it isn't really tied to any particular chair. And we used to renew it every year. Now we do it every 5 years. So, but I don't think I've never heard anyone raise this issue that a new chair might want to come in and go in a completely different direction. I really don't think that's right. But but that's not going to be up to me to decide.
Is that affecting at all who you're consulting with?
Not at all. Not in any way.
Thank you. Chair Powell, Matt Egan from CNN. Relatively low gas prices this year have helped drive down inflation in recent reports, but that trend is starting to reverse given the crisis in the Middle East. How are you thinking about how the Israel-Iran conflict will impact the economy, especially inflation, and what lessons were learned during the 2022 period when another conflict, the Russia-Ukraine war, sent oil and gas prices skyrocketing?
So, of course, we're watching, like everybody else is, what's going on. I really don't have any comment on that. Possible that we'll see higher energy prices. What's tended to happen is when there's turmoil in the Middle East, you may see a spike in energy prices, but tends to come down. Those things don't generally tend to have lasting effects on inflation, although, of course, in the 1970s, they famously did, because you had a series of very, very large shocks. But we haven't seen anything like that now. The U.S. economy is far less dependent on foreign oil than it was back in the 1970s. So, but there.
A quick follow-up. I've just got to ask you about artificial intelligence. Some technology executives have recently been warning that AI could wipe out a large chunk of entry-level jobs and significantly increase the unemployment rate. I'm wondering how concerned you are, if at all, about the threat that AI poses to employment.
So this is the question. The question really is, will AI be more augmenting labor or replacing labor? And I wouldn't, we all see those announcements, including one today. I wouldn't, overread a couple of data points because, AI should be creating jobs at the same time. It may be replacing, maybe doing both. Anyone who's done any work with AI will have been a little bit stunned at how capable it is. And it's just a different thing. So I think this is something that certainly has transformational potential. And probably we're in the very early stages of it. They say what you're seeing now compared to what you'll see in 2 years is going to be very different and even more effective. So I think it's really hard to know. Of course, there are optimists who feel like it's going to make everybody much more productive. And there are those who think it's going to replace an awful lot of jobs right across the income spectrum, white collar, blue collar, and everything. So I just don't know. We don't have a house view on that, but this is going to be a very important question for some time.
Greg.
Thank you. Greg Rapp from MarketWatch. I was wondering if you could step back a little bit, Chair Powell. There's a spate of articles and a lot of op-eds now in the newspapers saying that the U.S. economy and the global economy is going through this profound change, akin to the end of the Bretton Woods era in the 1970s. And don't you owe the American people some sort of explanation for what we're going through? I mean, I noticed earlier this month when you talked about Bretton Woods a little bit, and you said that Bretton Woods, the Fed staff had to change how the movements of the dollar was impacting the economy. Are we going through something like that now? That, are you having to change how you do monetary policy? Is it that fundamental a change underway? Thanks.
It's certainly a time of real change. From a geopolitical standpoint, from a trade standpoint, from an immigration standpoint, you see this not just here but everywhere. So there's quite a lot going on. It doesn't change the way we do monetary policy in the near term. And it doesn't change our objectives or what we need to do. And these things are not really our issues. They're really issues for elected governments. All of those issues are really for elected governments. But there's no question it's a time of real change, and very hard to see where that goes. Will it be? There have been many things written about how it's going to be a more inflationary time. That's possible. It's not guaranteed. AI could cut in the very other direction. AI could make people much more productive and push in the other direction. I don't know though. But you're right. But honestly, our focus is a much more practical one, and that is how do we keep inflation low and employment high in the near term. That's really what we're about.
Mark. Mark Hamrick.
Hello, Chairman Powell. Mark Hamrick with Bankrate. What is the view about the growing amount of slack in the job market, including the softening in payrolls, the forecast of a modest rise in the unemployment rate, and the ability of workers to demand wage hikes or not in this environment where you have inflation surging?
You don't really see unemployment going up. You don't see increased slack, really. At the margin, remember, you're at 4.2% unemployment. That was, for many years, that was a extremely low level. It happens to have come up off of an even lower level as we came out of the pandemic. We were as low as 3.4%, but 4.2% is probably at the low end of estimates of the longer run, sustainable level of natural rate of unemployment. So I guess I wouldn't agree with that. And also, in terms of wages, real wages after inflation have been moving up sort of more than was consistent with 2% inflation. They're still moving up at a healthy clip, and I think much more consistent with 2% inflation given a reasonable assessment of trend productivity. So it's a pretty good labor market. You're right that the level of job creation has come down, but so has the supply of workers, the change in the supply, the new supply. So you've seen the unemployment rate remain pretty stable at 4.2. It's been as high as 4.3, but those are good numbers. So it's a pretty good labor market. There's a more concerning thing is there are not a lot of layoffs, but there are not a lot of job creation. If you're out of work, it's hard to find a job, but very few people are being laid off at this point. So that's an equilibrium we watch very, very carefully, because if there were to be significant layoffs and the job finding rate were to remain this low, you would have an increase in unemployment fairly quickly. But that hasn't happened. It really hasn't happened. The U.S. economy has defied all kinds of forecasts for it to weaken, really, over the last 3 years. And it's been remarkable to see just again and again when people think it's going to weaken. Now, eventually it will, but we don't see signs of that now.
Go to Jean for the last question. Hi, Chair Powell. Jean Young with MNI Market News. There's been a lot of talk about cuts. I wanted to ask you, why do you think there are no forecasts for rates to rise or even to stay where they are next year, given that the projection for inflation is to rise to 3%, and there's a lot of there's some skepticism over whether those price hikes will be a one-time event?
So there are a number of people on the committee who wrote down no cuts this year, but some cuts next year. So, I think, people are writing down their most likely path, right? They're not saying there's zero possibility of other things. Really, think of it as the least unlikely path in a situation like this where uncertainty is very high. I think, again, people write down their rate paths, and they do not have like a really high conviction that this is exactly what's going to happen over the next 2 years. No one feels that way about their rate path. They feel like, what am I going to write down? I mean, what would you write down? It's not easy to do that with confidence. So I would just say it that way. We don't rule things in or out. Certainly a hike is not the base case at all. It's not something people are writing down. But in the meantime, we do the best we can with these forecasts, and I think they're representative of the different forecasts and different reaction functions that people on the committee have. So thank you very much. Thanks.
Okay, guys, so that is the end of the FOMC meeting. You can kind of see the SPY slightly green on the day still, but honestly, a very muted reaction here. Like, we didn't get much of a big response from this FOMC meeting. Powell seemed kind of reluctant to answer questions. One of the things I told you guys before was that Powell was going to be very data dependent. He's going to say the labor market shows resilience, which he did. He said that inflation is still above their target. It is still elevated, which he did say that. That's what I said before. It's kind of getting predictable at this point in time. If we take a look at the odds now, which I think are important to look at with the updated projections now for rates in terms of this year in 2025. Again, the dot plot update, if we take a look at July now, we got a 10% chance of a cut in July, July. And I don't know if they've updated this. Yeah, so July is still showing a 10% chance of a cut. So 10% is 10%. I mean, it's not a small percentage. It could happen. But the situation in which this would happen would be a situation in which we have higher inflation, which would be a situation in which we have lower inflation and weaker economics. So if we have low inflation and weak economics, that's going to open up the odds for rate cuts this year, So it's still looking pretty probable that by September, we're going to get a 25 basis point cut. These have gone up a couple percent since the last time I looked at it pre-meeting. Currently about 57% likelihood of a 25 basis point cut by September, and then a 50 basis point cut. We got about 6.2% chance. So when you add these together, you get about a 63% chance likelihood of a cut by September. 63% is what the current probability is for a cut. And let me know what you guys think about this. It's really interesting. Again, if you want to check out Top Step, if you want to help support the channel, as always, guys, remember, I'm not an investment professional. I'm not liable if you lose. Always make your own assessment. Trade smart, guys. I can't guarantee anything. The market is very sideways right now. If I do take a position, it's going to be kind of like a range-bound position. But check out Top Step. It's a beautiful way to learn. Top Step, most day traders lose money. And so if you fund your own account thousands of dollars, let me be real here, you're probably going to lose money. Like, that's what happens in the first few years day trading. Regardless of what course you take, who your mentor is, they're gonna promise you different. Most day traders lose. And so you can either fund your own account trying to look cool in markets, or you can try Top Step. They give you a 50K demo. If you can make 3K in profit on that demo without losing 2K first, following their rules and conditions, and there's a 100K challenge and a 150K challenge as well. The 50K one's $50. If you pass it, you get to keep your first 10K in profit and then 90% split afterwards. It's very similar to funding your own account. If you fail, you're out $50. It's the best of both worlds. The perfect way to learn. And they pay out millions, fund thousands. They have a platform as well. It's called Top Step X. Check it out here. You can see it pinned to the top of the chat. I'll put it up in the description as well. Let me make sure I got it up in the description. But if you want to check them out, here's the links. I got to redo. There we go. Top Step. So I just put it in the description as well. You might have to refresh. But I just put it in the description as well. I appreciate the love. Yeah, we got some Middle Eastern news. They said a meeting on the overseas conflict is going to happen with the president very soon. So that news dropped. Yeah, it takes so much time. Like, people are going to... Most people that lose, which is going to be most people, some of them might cry about prop firms or funded account programs. But the reality is most day traders lose, right? And you can either... Again, I came from... When I first got started, I got started in penny stocks. And I thought I was about to be rich. I thought I was going to be a guru, savant. I guess I did. I mean, I'm not a guru, but I thought I was going to be rich. Day trading penny stocks. I naively realized how risky it was after losing $4,000 in about 3 weeks. And if I could go back, I'd definitely do something like this because it's just a cheaper way. Your risk is less. You still have some pressure, which is important. Like a regular paper trading account, it's not going to do much. But it gives you some pressure. Like, it's a middle ground. But it's not the full extent of 5, 10, 20, 30 grand. Like, a lot of traders end up just destroying. You know, they had that story of that trader that made $100 million. And again, I think this dude's probably just a gambler. I'm not trying to hate. But if you make $100 million and you keep pushing instead of walking away and living your life like made wealthy, if you make $100 million from, I think it was like $5 million, and instead of cutting it and riding off into the sunset happy, you decide to keep pushing, and then he ended up losing his whole $100 million. And now he's trying to sue or something. Like, I don't remember what he's trying to do, but honestly, he's probably just a gambler, right? Like, if you don't walk away after $100 million, what are you doing? You know? But yeah. 3 million. Yeah. Yeah, I mean, again, what I got from this meeting, Powell's very data dependent. He's apprehensive to get out of any type of outlook, and I understand it. He knows he's influencing markets with this decision, and he doesn't want to influence them too much in any way, I think. At the same time, I think you could probably argue a 25 basis point cut right now, especially if you continue QT, which is what they're doing. You keep it balanced. You do a 25 basis point cut. You continue quantitative tightening. One's dovish, one's hawkish, and it's balanced, right? I think that's justifiable, but it's also in an area where I think we're still in the middle. You know, like what he's saying about interest rates is not wrong, meaning interest rates are about in their 30-year average right now. So people are acting like interest rates are just crazy high and it's the end of the world. Most of those are lenders or you know, whomever. I understand other people wanting to buy a house, and so everybody has their own bias. But interest rates are pretty close to their 30-year average. So it's not like interest rates are at the top, right? Like, people are acting like they're just crazy high. I think what happened is that people got used to the last 20 years. And so people got used to the last 20 years. And so, you know, they forgot how bad it could be. Like, 80s, early 80s, terrible for interest rates, terrible. Crazy high inflation, just problems. When were interest rates the highest? Yeah, early 80s, 1981, average rate for 30-year mortgage reached 17%. And so people forget this, you know. But at the same time, again, I try to be balanced and fair. I think you could probably argue a 25 basis point cut, especially if we're continuing QT. But, you know, it is what it is. That's how it goes, you know. You know, we did a poll here. We asked people, with what Powell said during the conference, are you more bullish or bearish for 2025? Let me know how you feel. But, yeah. Again, you can give me a follow at Beginner Trades. Great way to help support the channel. We cover all this stuff breaking live. You can see the NASDAQ and the SPY start to break down here. SPY starting to fall. I was thinking about shorting at the top of this range too, but maybe I'll buy. I think so. We might have some overseas news going on too. So we will see. I'm going to try to buy the bottom here. See what happens. This is a challenge account, by the way. So if we fail, Not the end of the world. I didn't realize I was on the regular NASDAQ though, which is kind of crazy, but hey, that's all right. We'll play with it. I think we already got a pretty big cushion on this thing on the day. All right, so we're almost flat. Let's see if we can get it. Maybe we can add back here. So we're completely flat on the day here. And this is a challenge account, so if we fail this, you know, it's 50 bucks. And this is what I'm saying. Like, you can risk something. It's not the end of the world if you fail it. If you pass the test, 50K funded account, 90% split. And they pay out millions. I think Top Step's paid out, like, almost 200 million in the last few years. I have to go check. But yeah. Look at this rip. Almost right back up here. We're slightly green now. Take a little off here. There we go. We're gonna double size, triple size. There we go. Okay, so we are up now on that bounce. We're up about $820 here. So we caught the bounce. That's good. And you see how similar this is to day trading stocks. No PDT rule. Remember, guys, markets close tomorrow most of the day. Futures markets are open, but it's going to be kind of boring. I think the NASDAQ and the E-mini are still open, but it's going to be kind of boring, I think. And so just remember, futures close at 1. I'm pretty sure stock markets close completely. And it's going to be kind of sideways, most likely. Who knows? Maybe the market runs or doesn't run. But yeah, again, check out Top Step. We just made 800 and something on a challenge account, so we're just having fun with it. I'm not going to trade my actual funded accounts here on this. It's too risky, you know. But hey, we'll see how this goes. Hey, I love you all. Y'all be safe. Again, check out Top Step. Links pinned at the top of the chat if you want to check it out. Great way to help support the channel. This is Top Step X. If I trade stocks, it's on TOS, which is on the right side here. This is TOS right here. But yeah, I'm going to get out of here. Hey, y'all be good. Be safe. Stay safe in this market, guys. It's a little crazy. And, yeah, y'all be good. We'll see if we look at the previous closing price right here. So we'll see if we hold. Buying the bottom of the range worked, though. So buying this bottom of the range, it did work. I'm not telling you what to do, though. Remember, guys, can't guarantee anything. Not an investment professional. I'm not liable if you lose. Always make your own assessment. Trade smart. I can't guarantee a thing. Sometimes I trade and lose off stream. You might not see it. Later, Sam. Later, Chuck. Ali. Pawn. Yeah, hey, I tested positive for the flu this morning, so I'm probably going to go lay down, guys. And I don't feel good at all. Like, I was honestly secretly waiting for the stream to end, but, like, I get a little adrenaline when I stream. I mean, I got thousands of people watching me, so that's pretty standard, I think. But I'm going to go lay down now. Hey, have a great day, guys. Y'all be safe. Stay healthy. I'll see you guys.